Investing in IPOs, initial public offerings, is often seen as a gateway to quick profits and long-term wealth creation. For many, it's about being part of the next big success story from the very beginning. But before you ride this wave of excitement, there's one crucial detail you should never ignore: insider selling. What does it really mean when the founders or early investors start selling their shares? Is it normal, or is it a red flag? In this video, let's break down the meaning, risks, and how you, the investor, can spot early warning signs and make smarter IPO decisions. Insider selling refers to the sale of shares by individuals who are closely associated with the company, like the founders, executives, or early investors, either during the IPO or shortly after. While this may seem concerning, not all insider selling is bad. It could be a normal part of the financial journey, but in some cases, it may signal that insiders lack faith in the company's growth. The challenge lies in understanding the intent behind the sale, and that makes all the difference for an investor like you. So why do insiders sell their shares? There are 4 major reasons. First, wealth diversification. They want to spread out their assets instead of relying on just one company. Second, personal or business needs. They may need funds for other ventures or causes. Third, it could be an exit strategy. Venture capitalists often cash out during IPOs. Lastly, they might believe that the company is currently overvalued and want to maximize returns. While all these reasons may be valid, the key is to ask, does this selling align with the company's future? If not, that's a warning sign. The impact of insider selling on stock prices can be significant. Let's look at 3 scenarios. First, negative impact. When there's massive insider selling, it often signals a lack of confidence, which can trigger panic selling by retail investors, causing a sharp price drop. Remember Zomato? After the lock-in period ended, major selling led to a steep fall in its stock price. Second, neutral impact. If insiders clearly communicate that selling is for diversification or philanthropy, the market may stay stable. Infosys founders did this transparently in the past. Third, positive impact. Sometimes, insider selling improves market liquidity, attracting institutional investors and boosting long-term stability. So, the context matters. As an IPO investor, your most powerful tool is the Red Herring Prospectus, or RHP. This SEBI-mandated document lays bare the facts. Look at the shareholding pattern before and after IPO. A major drop by insiders could be a red flag. Check the objects of the offer. If a big part of the IPO is an offer for sale, where proceeds go to insiders, ask why they're exiting. Understand lock-in periods. Promoters must retain at least 20% of post-IPO capital for 18 months. Any aggressive selling after this period needs scrutiny. Also, read the management's discussion and analysis. Match the company's vision with insider activity. If they don't align, think twice. I'll be on alert if you spot these red flags. High insider selling proportion. If key insiders are dumping large stakes, it may indicate weak confidence in the company. Repeated post-IPO selling. Regular selling by top executives might mean they're cashing out, not building the company. Lack of transparency. If reasons for selling aren't clearly communicated, that's a major concern. Transparency is the key to trust. Smart IPO investing is all about balance. Don't put all your capital into one IPO. Diversify across companies and sectors. Set realistic expectations. IPOs can be volatile. Know your risk tolerance. And most importantly, use expert insights. Read analyst reports. Follow reliable financial platforms, and learn from market history. A single red flag may not mean disaster, but several together should not be ignored. To sum it up, insider selling doesn't always mean trouble, but ignoring it could be costly. Always read the RHP carefully, understand the context, and watch for patterns post-IPO. Insider selling, when done transparently and for the right reasons, can be harmless. But when it's excessive, poorly timed, or not explained, it's time to be cautious. Whether you're a first-time IPO investor or a seasoned one, staying informed is your best defense. If you found this video useful, don't forget to like, share, and subscribe. Ready to invest in an IPO? The first step is opening a trading and demat account. To be IPO ready, click the link in the description below. Happy IPO investing!